Well, good morning. It's very nice to be here. Very nice to be from Kansas State University. And I chose not to wear all purple today, just to be neutral. My position at K-State in the Department of Agricultural Economics is an extension position. Some of you might be familiar with extension. You may be familiar with 4-H and some of the other activities that extension does around the state. But my primary responsibility is farm management. And so I spend most of my time doing research on and working with people in the ag industry, farmers, ranchers, agricultural lenders, input providers, and certainly also our policymakers. And that gives me the opportunity to stay pretty in tune with the thoughts and the ideas and the perspective of that industry. So I'm very happy to be here today to share with you some economic analysis of the sector and what's going on, because there's some interesting things going on that are very likely to have some ramifications on the greater Kansas economy. So let's get started. I want to give you some context in which, so you can understand sort of what's going on and what's been driving the sector for the last couple of years. This chart is made up of data from the Kansas Farm Management Association. That is a group of roughly 2,000 farmers from across the state who provide their economic data to our department, and we analyze it for them and help them make management decisions and tax decisions. But this data also gives us an opportunity to really see what their profitability is. So this chart runs from 2001 through 2013. And what you can see between 2001 and 2006 is something that Econ 101 we would say is a highly competitive industry, where profits tend to average out at about zero. Right? And farming is a pretty competitive industry. They're selling in the commodity markets. It's pretty hard to specialize and have a specialized commodity. So it's actually kind of textbook Econ 101 to have a sector that has this zero profitability over the long run. But then you can see starting in 2007, that wasn't the case at all. And these are the returns to wheat, corn, beans, and milo, also known as grain sorghum, for the north central region of the state. And now, from 2007 through 2013, this is a very high profitability period of time. And so this is a very dramatically different situation than what we've seen over the long run. Now, this chart only goes through 2013, and if I could just stop right there, it would be great. But instead, I need to update this. So let's take a look and see what happens when I update it through 2014. Okay? And then let's take a look at 2015. That's a lot of volatility on the profit side. We're used to volatility on the price side. But for net returns to farming, to go from very high profitability to very low profitability has been pretty dramatic for the industry and for a lot of the businesses surrounding it, all of our input dealers, machinery dealers, and so on and so forth. This is a look at, I would be remiss if I only showed you the crop side. Kansas agriculture is very much dominated by crops and livestock. We have a huge cattle industry. So here are some, this is net farm income by type of operation. Again, you're seeing that high level of income for the crop producers, which are the red lines, and then it falls off by 2015. We actually go from having an average of about $170,000 annual income per operation in 2013, all the way down to a statewide average net farm income of $4,000. That's $4,000 for the year, net farm income. The cattle side was in a long-run situation of about zero profitability, and then had several good years, and 2014 is what I call hitting the cattle lottery. Okay, those were the best cattle prices that we have seen pretty much ever, but it only lasted for 1 year. And it fell off more than half in 2015, and 2016 is going to have us back down around pretty low cattle prices. Okay, so a lot of volatility, and these things have implications well beyond the farm. Profitability for farming is going to be driven by a couple of things: the prices that they receive for their commodities and the cost of production. Okay, so if your crop prices fall off, in order to get back to profitable, you got to find a way to keep your costs down. But let's talk for a minute about crop prices, and they are highly volatile and driven not only by what we do here in Kansas, but by what happens in the rest of the world. Here's just a quick example of a couple years worth of price volatility for soybeans. If you look at this and you as a producer have to decide when you're going to market your grain, when you're going to price your grain, a matter of a few weeks can make a huge difference in what price you receive. In fact, in this past 2016, there was only a period of about 3 weeks where prices were halfway decent for corn. And if you didn't market during that period of time, you were hitting some pretty low prices. The other thing is our ability to compete in the export market. We certainly don't consume all the crops that we grow here or all the beef that we grow here. We export it. And our ability to compete in the market is largely driven by things like our trade agreements and also the strength of the dollar. The strength of the dollar, this happens to be compared to the Brazilian currency, the real, and it is, again, we're in a relationship where the Brazilian currency is very weak compared to the US dollar. What that means is that Brazilian soybeans are really cheap relative to US soybeans. So cheap, in fact, that earlier this summer, we had Southeast US poultry producers importing soybeans from Brazil because it was cheaper than bringing them in from Iowa. That's pretty amazing to me, and really tough on our domestic producers. So that is also hurting us. And then finally, so what about the cost of production side? Well, farmers are like the rest of us, and you start making a lot of money in your business, and you start looking at ways to reinvest it. And one of the places that we put it was into machinery. A lot of machinery. In fact, John Deere stock, Case IH stock, was doing really well there for several years. They were making good money because everybody was able to upgrade their machinery cohort and really have a lot of the opportunity to sort of get to the new technology. And there's a lot of new technology in farming right now. A lot of GPS-driven tractors and combines. And so we bought a large amount of new machinery. They were also given the opportunity to accelerate the depreciation, so they were able to offset a lot of that farm income for tax purposes. But we also saw, if you're able to make a lot of money off of farming, then the first thing you really want to do is be able to do more farming, right? Add land base, get more acres, make more money off of that land base. So people started getting very aggressive with trying to get more land. And they either did it through bidding up the price of land or through bidding up rental rates, trying to rent land from other people. So let's take a real quick look at this. If you start, the bottom row is the variable and total cost, respectively, for corn and beans in 2006. And that was before the big run-up in profitability. And as you go up the table, you see that cost of production have also gone up. And arguably, our prices now are more in line with what we were seeing in 2006. So just looking at the variable cost column for corn, we really need to have production costs down around $200 an acre, not $300 an acre. That's going to take a lot of adjustment to bring our costs down by nearly 50% in order to make $3 corn profitable. What are the impacts of low profitability in the sector? It's going to dramatically affect their ability to repay their debts, okay? We haven't had the cash flows over the last few years. I mean, negative cash flows, which means those operating notes that they get to buy their seed and their fertilizer, that they tend to pay those operating notes off at the end of the season when they harvest. They're not able to pay those off, and so they're rolling them into the next year. You can only do that for so long before it starts catching up with you. The other thing is that a lot of bankers are looking at restructuring loans right now. And by restructuring, I mean that they're extending out the life of those loans, taking advantage of low interest rates and trying to make the repayment a little bit more achievable for these producers. But we are beginning to see some liquidation of assets. And by that, I mean some selling off of some machinery or just simply not buying new machinery and trying to make what you have work for as long as possible. Obviously, there is the possibility that we'll start seeing some land go up for sale as a result of this restructuring. So why does all of this matter? I mean, I'm speaking to a group of business people from across the state, and some of you may be directly involved with agriculture, and some of you may not. But ag is very big in this state, and what happens in that sector, especially when we're looking at a major downturn in its position on a finance basis, is that we're going to see some implications for you and your communities. So let's talk a minute about some economic indicators. This is some information from the Bureau of Labor Statistics, and what it shows is employment growth in different parts of the state. So you have the red line at top, which is the metro job growth. It stayed above 0 for this 5-year period, so that's reasonably good given our general economic conditions. The green line is essentially suburban areas, and those have fallen off a little bit recently, but you can see the blue line is rural job growth. And starting in about fall of 2012, which is when prices started to soften, that is the point at which our job growth in the rural areas started to decline. And it's been on a downward trend ever since. This is especially this is especially challenging given that for a lot of producers, they supplement their income from the farm with off-farm income. A lot of them have spouses that work in town. It's a way for them to subsidize their healthcare costs and just get a more stable bit of income that can supplement family living expenses. Well, bankers also happen to look at that off-farm income as being more reliable, and they value it a little higher than they do, an equal dollar on the net farm income side. And so we're starting to hear a lot of bankers suggesting to these producers that they go get a job in town. So now you have a situation where job growth has been negative in the rural areas, and you've got farmers who are being told by their lenders, go get a job in town. So you've got more labor supply chasing fewer jobs. This is a chart from the Kansas City Fed. They do a quarterly survey of ag lenders in the region that they cover, which includes all of Kansas. And the question that they asked on their survey was, has the weakening agricultural economy started to affect Main Street business? Has it caused Main Street business activity to decline? And in 2014, there were only about 30% of the respondents in Kansas who said yes to that question. And then 1 year later, twice as many said yes, it's having a negative impact on Main Street. And then by 2016, this was asked in the first quarter, we're up to about 80% of the lenders saying yes, there has been a negative impact. So that's why when I bring up these things about agriculture and the situation that we're in, there's ramifications across the board for the state. Let's talk about land values for a moment. Land values, like I mentioned earlier, they were going up as a result of the high profitability. It makes sense. Those profits are going to go back into that fixed asset. That's our land base. That is the most fixed asset we have in agriculture. And we saw that upward trend for a very long time, and it really wasn't until 2015, which a couple of years after we started to see negative profitability, that the land values started to turn. And the question is, are they going to continue to fall? Are they going to stabilize? Are they going to go down? Not likely that they're going to go up. In order to get a little more insight onto that idea of where land values are going, here's a chart that goes back to 1950. I'll just say, have you noticed how much economists like charts? Yeah, there's been a lot of charts today. So this one goes back to 1950, and this is the nominal land values for the state of Kansas. Anybody know what that big jump up in the middle of that chart is? The bump, the run up and the come down? That was the 1980s. That was the 1980s farm boom and bust. We know it as the farm financial crisis of the 1980s. We ran up land values, and then they basically collapsed. Now, with the exception of that bump, all the way up through about 2005, 2006, the rest of the time, land values move up at a very modest rate. But then you can see at the end of this chart, we've got another big run up. So let's put these in nominal values, and it just makes that 1980s boom and bust even look even more dramatic. Same thing with what we're experiencing right now. And that's a little bit scary to people who own land. It's also a little bit concerning to anybody who's looking at taxing that base, right? Okay. With regard to whether or not land values are going to come back down, we do have some recent research that we've put together looking at 40 years worth of Kansas ag land values. And what we found was that over that period, the long-run capitalization rate was right around 4.6%. Now, with that piece of information and also looking at projections for net farm income for the next couple of years, which are going to be low, just like they have been for the last 2 years, what that implies is that in this profitability environment, we should be going back to average land values around $1,000 an acre. And if we go back to that, that's nearly a 50% drop in land values from the peak in 2015. It gets us back to land values that we had in 2006. So if this happens, what we'll do is we will have lost all of the value that we added to it over that entire 10-year period. I'll speak about property taxes because, again, this is related to some of the things that I've been talking about. And I find that I'm not from Kansas. I'm originally from Montana. And so I didn't understand how the property tax system worked. But I assumed that everybody from Kansas did, right? Yeah? Oh, yes. Okay. No. It turns out, no, most of us don't. We understand that we get the statement once a year. Pardon my French, but we bitch about it, we write the check, and then we mail it back, okay? But one of the things that was very obvious to people in the last year was that they had gone up by quite a bit. So we felt like it was, well, let's explain how this works so you can kind of understand. It's an 8-year average of an 8-year average, which basically means that we're going to smooth out this calculation so that it doesn't have a lot of volatility to it on a year-to-year basis. That's good for landowners so that they don't see big jumps in their property taxes. It's also good for planning on the budget side for counties and for the state. And so the goal, again, is to smooth that effect on taxes as you go forward. So here's that 15-year period that is currently being considered or used in the property tax calculation. And what you see is that you've got that early period of modest returns, and then there's sort of a downturn, and then you can see the last half of that chart starts to steadily go up. All right, and so the question is, why are my property taxes going up? Well, here's how that calculation is actually done. It puts the heaviest weight on the middle years and the lowest weight on the earliest and the most recent years. So if I take this weighting system and I overlay those returns that are being used in the calculation, what you can see is we have gone from a period where we have heavily weighted the lower return years, and we're starting to transition into where we're going to weight the higher return years. So for the next several years, you're going to see ag property tax rates go up because they are now capturing that high profitability period. Doesn't have anything to do with what's going on right now. Right now it's low profitability, but the property tax formula hasn't caught up with that yet. Okay? In closing, I would just like to say that the presence of these couple of years of low profitability has started to make a few people nervous that we might be looking at a repeat of the financial crisis from the 1980s. Okay? And so I want to speak to that for just a moment. But first, I will say that when economists make predictions, we make weather people look good, okay? So take it for what it's worth. I'm going to give you my prediction, my opinion, all right? And if I don't ever get invited back here, then I don't have to worry about whether I was right or wrong. Given where prices are today and cost of production and land values, we definitely are still going to see a correction. I think this is going to last for at least a couple more years because we're too far apart. What does that mean for the individual producer? It means they're going to have to get creative on finding ways to lower their cost of production. They're going to have to be very conservative with their cash flows and make sure that they're servicing their debt. Some producers will not make it out of this downturn, okay? But there will be plenty that will be left. Kansas agriculture has been here since the beginning. It will be here well into the future, but yes, we will see some contraction in this segment, and we will likely see a few farms and ranches not make it, and that is sort of the nature of this business being highly competitive. So we've seen an expansion. I think that we're going to see a contraction, and it's going to last for at least a couple more years. So thank you very much for having me, and I'll go ahead and turn the podium over.